Welcome to our comprehensive guide on managing political risk in international business. As companies expand across borders, they face a variety of challenges, and political risk is one of the most significant. Political risk refers to the likelihood that political decisions, events, or conditions will affect the business environment in a way that could impact profitability or operations. Understanding political risk is crucial for any business looking to succeed globally. In this video, we'll explore what political risk is, why it matters, and how businesses can effectively manage it to ensure long-term success. Political risk comes in many forms, ranging from sudden government changes to ongoing regulatory shifts. Some risks are macro, affecting all businesses in a country, while others are micro, targeting specific industries or companies. Examples include expropriation, currency restrictions, and changes in tax policy. By recognizing the different types of political risk, companies can tailor their strategies to address each one more effectively. This foundational understanding sets the stage for deeper analysis and proactive management. Macro-political risks impact all businesses operating within a country. These can include widespread political instability, civil unrest, or sweeping regulatory changes. On the other hand, micro-risks are specific to certain sectors, regions, or even individual companies. For example, a new law targeting foreign technology firms would be a micro-risk. Understanding the distinction between macro and micro risks helps businesses prioritize their risk management efforts and allocate resources more efficiently. Political risk can stem from a variety of sources. These include government instability, corruption, policy changes, and international conflicts. Elections, coups, and shifts in political leadership can all create uncertainty for businesses. Additionally, social movements and public protests may influence government decisions, further increasing risk. By identifying the sources of political risk, companies can monitor relevant developments and anticipate potential challenges before they escalate. One of the most severe forms of political risk is expropriation, where a government seizes private assets without fair compensation. Nationalization, where entire industries are taken over by the state, can also occur. These events can devastate foreign investors and disrupt operations. Understanding the legal environment and historical precedents in a country can help businesses assess the likelihood of expropriation or nationalization and take preventive measures. Political decisions can lead to currency controls, devaluations, or restrictions on capital flows. These financial risks can significantly impact a company's ability to repatriate profits or manage costs. Monitoring government policies and economic indicators is essential for anticipating such risks. Companies often use financial instruments or local partnerships to mitigate the impact of currency and financial uncertainty. Changes in laws and regulations can create uncertainty for international businesses. New taxes, tariffs, or compliance requirements may increase costs or limit market access. Staying informed about regulatory trends and maintaining strong legal counsel are key strategies for managing these risks. Companies should also engage with local stakeholders to anticipate and adapt to legal changes more effectively. Social and cultural factors can influence political risk. Public opinion, cultural norms, and social movements may pressure governments to enact policies that affect foreign businesses. Understanding local customs and building strong community relationships can help companies navigate these risks and maintain a positive reputation. Political violence, such as riots, terrorism, or civil war, poses significant risks to international business operations. These events can disrupt supply chains, endanger employees, and damage assets. Companies must assess the security situation in each market and develop contingency plans to protect their people and investments. Sanctions and trade barriers imposed by governments can restrict business activities and limit market access. These measures may be implemented for political reasons, such as diplomatic disputes or human rights concerns. Companies must monitor international relations and comply with all relevant regulations to avoid legal and financial penalties. To manage political risk effectively, companies use a variety of assessment tools. These include country risk reports, political risk indices, and scenario analysis. By systematically evaluating the political environment, businesses can identify potential threats and opportunities, allowing for more informed decision-making. Country risk analysis involves evaluating the overall stability and predictability of a nation's political and economic environment. Factors such as government effectiveness, legal systems, and social cohesion are considered. This analysis helps companies determine whether to enter, expand, or exit a particular market. Scenario planning is a proactive approach to managing political risk. By envisioning different political developments, companies can prepare for a range of outcomes. This process involves identifying key drivers of change, developing plausible scenarios, and creating response strategies for each. Scenario planning enhances resilience and flexibility in uncertain environments. Political risk insurance is a valuable tool for protecting investments against losses from political events. This insurance can cover risks such as expropriation, political violence, and currency inconvertibility. By transferring some of the risk to insurers, companies can operate with greater confidence in volatile markets. Building strong relationships with government officials and engaging in lobbying efforts can help companies influence policy decisions and reduce political risk. Effective government relations involve regular communication, participation in industry associations, and demonstrating a commitment to local development. These efforts can foster goodwill and create a more favorable business environment. Partnering with local firms or forming joint ventures can help foreign companies navigate political risk. Local partners often have valuable insights into the political landscape and can assist with compliance and relationship building. These alliances can also demonstrate a long-term commitment to the host country, reducing the likelihood of adverse government actions. Diversifying investments across multiple countries or regions can reduce exposure to political risk in any one market. By spreading operations and assets, companies can cushion the impact of adverse events in a single location. Diversification is a fundamental risk management strategy for international businesses. Developing flexible supply chains allows companies to adapt quickly to political disruptions. This may involve sourcing from multiple suppliers, maintaining inventory buffers, or establishing alternative logistics routes. Flexibility ensures business continuity even in the face of sudden political changes. Well-drafted contracts can provide legal protection against political risk. Clauses such as force majeure, arbitration, and stabilization can help companies manage disputes and adapt to regulatory changes. Working with experienced legal advisors is essential to ensure contracts address relevant risks. Continuous monitoring of political developments is crucial for timely risk management. Companies should track news, government announcements, and policy debates in their target markets. Early detection of potential risks allows for proactive response and minimizes negative impacts. Building strong relationships with local communities can help companies gain social license to operate and reduce political risk. Community engagement involves supporting local initiatives, creating jobs, and addressing social concerns. Positive community relations can influence government attitudes and foster a stable operating environment. Corporate social responsibility (CSR) initiatives can enhance a company's reputation and reduce political risk. By investing in education, health, and environmental projects, businesses demonstrate their commitment to the host country's development. CSR can build goodwill with both governments and local populations, making adverse actions less likely. Operating ethically is essential for managing political risk. Companies that adhere to high standards of integrity and transparency are less likely to face regulatory scrutiny or public backlash. Ethical practices also foster trust with stakeholders and support long-term business success. Effective crisis management plans are vital for responding to political emergencies. These plans should outline roles, responsibilities, and communication protocols. Regular training and simulations ensure that employees are prepared to act quickly and minimize damage during a crisis. Protecting employees is a top priority in politically unstable environments. Companies should implement security measures, provide safety training, and establish evacuation procedures. Ensuring employee well-being not only fulfills legal obligations but also supports business continuity. Clear and consistent communication is essential for managing political risk. Companies should keep stakeholders informed about potential risks and response plans. Transparent communication builds trust and ensures that everyone is aligned during periods of uncertainty. Strong leadership is critical in navigating political risk. Leaders must make informed decisions, inspire confidence, and guide their teams through uncertainty. Effective leaders foster a culture of resilience and adaptability, ensuring the organization can weather political storms. Regular training programs help employees understand political risks and their roles in managing them. Awareness initiatives ensure that staff can recognize warning signs and respond appropriately. Investing in training builds organizational capacity to handle political challenges. Leveraging technology and data analytics can enhance political risk management. Advanced tools can monitor political developments, analyze trends, and provide early warnings. Data-driven insights enable companies to make faster, more informed decisions in dynamic environments. International organizations such as the World Bank and IMF play a role in stabilizing political environments. Their involvement can signal lower risk and provide support for reforms. Companies should monitor the activities of these organizations in their target markets. When disputes arise due to political actions, legal recourse and arbitration can provide resolution. International arbitration offers a neutral forum for settling conflicts between businesses and governments. Understanding available legal options is essential for protecting company interests. Having a clear exit strategy is important for managing political risk. This may involve divesting assets, relocating operations, or scaling back activities. Planning for exit ensures that companies can minimize losses and protect their reputation if the political environment becomes untenable. Let's look at a real-world example: the oil industry in Venezuela. Over the past decades, foreign oil companies have faced expropriation, currency controls, and political instability. Many firms had to write off investments or exit the market entirely. This case highlights the importance of thorough risk assessment and flexible strategies in high-risk environments. Companies operating in China have encountered unique political risks, including regulatory crackdowns and data localization requirements. Some firms have adapted by forming joint ventures or complying with local laws, while others have scaled back operations. This case demonstrates the need for adaptability and local partnerships in managing political risk. International retailers in Russia have faced challenges such as import restrictions, currency volatility, and shifting regulations. Some companies have succeeded by localizing supply chains and products, while others have struggled. This example underscores the importance of flexibility and local adaptation in politically sensitive markets. Banks operating in Africa often face political risks such as regulatory uncertainty and sudden policy changes. Successful banks invest in local relationships and maintain strong compliance programs. This case illustrates the value of government engagement and robust risk management frameworks. Manufacturers in Southeast Asia must navigate risks such as labor strikes, policy shifts, and infrastructure challenges. Companies that invest in local workforce development and engage with governments tend to fare better. This example highlights the importance of proactive engagement and adaptability. Pharmaceutical companies in India face risks related to intellectual property rights and regulatory approvals. Firms that build strong local partnerships and invest in compliance are better positioned to manage these challenges. This case demonstrates the need for legal awareness and local collaboration. Agricultural businesses in Latin America often deal with land reform policies, social unrest, and export restrictions. Companies that engage with local communities and diversify crops can better withstand political shocks. This example shows the value of community relations and diversification. Automotive companies in Eastern Europe face risks such as shifting trade policies and labor market changes. Firms that invest in local supply chains and maintain flexible production processes are more resilient. This case highlights the importance of supply chain flexibility and local investment. Tourism businesses in the Middle East must manage risks such as political instability and security threats. Companies that prioritize safety and collaborate with local authorities can better protect their guests and assets. This example demonstrates the need for security measures and government cooperation. Food companies in Africa face challenges such as supply chain disruptions and regulatory changes. Firms that invest in local sourcing and build strong government relationships are more likely to succeed. This case highlights the importance of supply chain management and stakeholder engagement. Mining companies in Australia must navigate environmental regulations and indigenous land rights. Successful firms engage with local communities and comply with strict standards. This example shows the value of environmental awareness and community engagement in managing political risk. Fashion companies in Turkey face risks such as currency fluctuations and political protests. Firms that hedge currency risk and maintain flexible operations can better manage these challenges. This case demonstrates the importance of financial risk management and operational flexibility. Summary: managing political risk is essential for international business success. By understanding the types and sources of risk, using assessment tools, and implementing proactive strategies, companies can protect their investments and thrive in global markets. Remember, political risk is dynamic, and continuous monitoring and adaptation are key. With the right approach, businesses can turn political challenges into opportunities for growth and resilience.